Fears of the 2020 recession are so rampant that Google Trends shows the term recession as a recent breakout term. And why is that? Well, I think it's mostly because many of us are very human. We're uncertain and we like certainty. We don't like volatility in the stock market. We don't like reds and greens. We like to see solid growth, things we can plan on, things we can feel comfortable investing in. How can we possibly feel comfortable investing in stocks right now? Or many of us, how can we possibly feel comfortable with the idea of signing up for a 30-year mortgage when the market is so uncertain? Well, in today's Meet Kevin Report, where I report news that makes you money, we're going to be talking about what you should do to plan for the possibility of a recession, but more importantly than planning for the possibility of recession, we're going to be talking about how this recession is made in China and how we're going to solve it in America. And specifically, I want you to be a part of the solution. And make sure to stick around to collect your 4 tips for surviving the 2020 recession in this video. So let's go ahead and start by taking a look at the economy. After all, and I hate to say it, but when people hear that somebody got cancer, what's the first thing that we usually think to ourselves? Oh, what kind is it? And then, what do? Oh my gosh. I hope I don't get that. What are the odds? Why do people get it? Oh, poor diet? What? Oh, whew, good thing I'm vegan. I'm good. Like, that's so normal, right? Because we don't like that feeling of, oh my gosh, something bad is happening. I don't want something bad to happen to me. And I think that's exactly why so many of us are searching Google and YouTube right now for information related to the possible recession. Yet every single time we look for data on this, we come up with stuff like this. This is The Economist, and The Economist tells us the onset of a downturn is as much a matter of mood as it is of money. And that's when we start realizing, wow, wait a minute. Underlying statistics, let's take a look. We have 164,000 jobs that were just added to the economy. GDP growth held at 2%. Yeah, there were expectations that it would be 2.1%, but remember, in order for us to have a recession, we need to see this GDP number decline, first of all, to a negative territory, but we would expect to see larger declines faster. And yes, things can turn quickly, and I always encourage you to be watchful of those. In fact, I'll always be reporting those here on this channel, so make sure to subscribe. But what else? Retail sales are through the roof. Consumer confidence is up. And then the argument comes up, well, we're at historic levels of debt. People have more car debt than usual. People have more credit card debt than usual. Yet, when we compare that to the percentage that people are spending of their monthly income on household debt, we're nowhere near at scary levels. So I think it goes without saying that the economy right now is in the weirdest point that it's ever been. We're very uncertain. And part of that is because we can't really look to history to say, okay, well, hey, you know what? Let's figure out the last time somebody pulled a gun on a cop, what happened? And we pull up books and we try to learn, okay, what happened in the last recession? We could study this all we want. But unfortunately, unlike when you pull a gun on a cop, you know you're gonna get shot. When you have a recession problem that has never happened before in history, we start wondering, wait a minute, this is really weird. We look towards global growth and we see that global growth appears to be slowing, but it was never really booming after the last global financial crisis. So it's entirely possible that the rest of the globe is still looking to get out of the 2008 global financial crisis. While at the same time, many of us are looking for anything that says, you know what? The recession is coming. And why are we looking for that? We're looking for that because secretly, we all know it. We all want to go shopping in 2011 and 2012 again. Come on, you know you want to go buy some stocks in 2009 and 10 as well. Pick up some B of A at $5. I remember when it was at $5. I remember how I felt when I was 19 years old looking at it going, oh my gosh, I should buy that right now. Oh, but I'm too scared. I get it. I totally get it. And look, it certainly doesn't help that the world's largest economy, an economy that's almost as large as $20 trillion, is fighting with the second largest economy in the world, China, at $12.2 trillion in terms of size of economy. Yeah, the United States is almost double the size of China's economy, but still, when number 1 and number 2 are fighting, everybody else in the room is like, oh crap. In fact, think of this analogy. When mom and dad are fighting, us as a child in our memory oftentimes looking, we're just like, huh? We're not actually thinking about playing at that time. Well, the same thing is true right now with the marketplace. And when mom and dad are fighting, it's usually the best time to go play because you can go do whatever you want. You're not being supervised. Well, very similarly to the economy, I think that when the United States and China have their trade battle, it's the best time to pick up really good deals in the marketplace, no matter what you're investing in, because there's so much uncertainty. So while the next recession might still take an unknown amount of time to develop, what should we be doing in the meantime? Well, that's where I have 4 money tips for you. And remember, I'm just some guy on the internet, so don't sue me, bro. My number 1 suggestion right now is make hay. Right now, the economy is still relatively booming. With the exception of manufacturing, the ability to crush it out there right now, if you are in sales, if you're in computer programming, if you're in whatever field you're in, it doesn't really matter. You should be going for a promotion. You should be locking in higher wages right now. If you're an entrepreneur, you should be killing it right now, doing whatever you can to push sales now. A lot of people talk about, oh, if a recession's coming, pay off debt and put money into savings. Well, let's be real. Before the recession is usually the best time to make a ton of money because everybody is usually spending right before a recession. And that's what we're seeing with the data. I never like to just talk blindly. I like to speak with data supporting me. And when the data says consumer confidence is up, I don't look at that and think, ooh, I gotta put more money into savings. I look at that and go, how can I spend some more money on business to increase my revenue? Because the bottom line is, the more money you have going into a recession, the better off you will be going through it and coming out of it. So number 1, increase your income. Figure out what you need to do to negotiate that raise, or you know what? Sometimes you just have to jump ship. It might be comfortable to stay where you are, but if you've capped out your income where you are, you might need to consider a different option. Here's an example. Somebody came to me the other day and said, hey, I make $30,000 a year working at the United States Postal Service. I want to invest in real estate and I want to follow the principles in your real estate investing course. Linked below and 22% off until September 10th. By the way, and now in this person's shoes making $30,000 a year, I thought to myself, okay, this is, we're working for a bureaucratic government. If you like that kind of work, something that could actually be very engaging, especially at a younger age, is something that I would have wanted to do, and I almost did do. Go work as a cop. In fact, most cops in their first year on the road are paid upwards of $55,000 to $60,000. Throw in overtime. There are cops that will come to my real estate investing events. Next one's Austin, by the way, and they're making $110,000, $120,000 because of the overtime. And so all of a sudden you look and you go, wow, even within the bureaucratic world of working for the government, there are opportunities to make more money. You might just have to sort of relocate or reposition where it is that you're working. Second tip, I'm a big fan of investing heavily, hugely in times like this because they're volatile. There's so many red days that create so much fear amongst other people that when I'm negotiating real estate contracts, I do it on a red day. When I'm looking to buy stocks, I buy stocks on red days. Today the Dow is up 326 points. I'm not buying today. I bought when the Dow dropped 800 points. That was the day I bought a lot of shares. And I posted on my Instagram which shares I bought, so be sure to follow me on Instagram too. So to me, really all of this Chinese combativeness is really an opportunity to just swoop in and keep buying, because guess what China's doing now? China is backing down to the power of the United States. Now look, whether or not you like the president, you have to recognize that the United States has a massive amount of clout. People want to do business with the United States. If things are painful here, imagine how painful things are elsewhere. That's why the 2008 recession was so terrible. Now I'm gonna give you some ideas for things to invest in, and then I'll also give you some safe harbor suggestions in case you're nervous and how to balance that. But something that you need to know when you're thinking about investing is you have to ask yourself, what are the odds of recession? And by most accounts right now, the odds of a recession within the next 2 to 4 years, or even within the next year, are generally pitted somewhere, and these are volatile estimates, but anywhere between 10 to maybe 30%. Well, in my opinion, this is a pretty slanted roulette table that says the odds are there won't be a recession within the next year, 2 or 3 years. Remember, when you play roulette, you have a 50% chance of landing on black and a 50% chance of landing on red. But what if somebody now picked up the table and slanted it so the odds were now 30%, 70%? Which side would you want to invest in? And in my opinion, that right now is the odds that there won't be a recession. There will be one in the future, but at least not in that near-term future. And so what am I doing? I'm throwing my money on the 70% side. And see, let's do a quick example. If I invested $50,000 over the next couple years, let's say, and I was able to make $25,000 by investing, and I'll show you how you can do that, and I was able to make that $25,000, now I have $75,000. In order for me to break even, that is be par again, the market would have to fall 33%. At the worst part of the financial crisis of 2008, real estate prices fell about 33% for most houses in most areas. Let's continue for a second down the absolute worst case scenario path. If you bought the absolute worst time to buy a Dow Jones index on September 21st, 2007, it would have declined all the way to its worst day. 47%. That means in the example that I made, where you invested $50,000 and you went to $75,000 because you invested the way that I suggest, that $75,000 would now be worth $39,000. And you look and you go, oh my gosh, I lost 47%. But because you invested, and you invested in opportunities that let you grow money, you actually really lost, in this case, a little more than $10,000. And that's if you struck buying at the most expensive day and you sold at the worst possible time. Had you bought just a couple months earlier, or had you not sold or sold a couple months later, you would have only lost about 17%. Worst case scenario. So notice how even if you made that mistake on the buy timing, if you just held on, the odds are you're not going to lose some crazy exorbitant amount. Like when you look at those worst case scenarios of losing 47%. I mean, just wait. But even if you made that mistake, the fact that you invested and made gains actually helped insulate you from really getting hurt. And see, that insulation is exactly why I buy stocks on red days and I buy real estate below market value. Now, a lot of people counter and they say, well, Kevin, if you buy real estate for $450,000, that means the market price of that real estate that day is $450,000, that you're not actually buying anything below market value. And this is somebody that just graduated Economics 101, because I too took Economics 101. In fact, I took many more economic classes. But what you learned in the later economic classes is that there can be disparity in certain fields such as real estate, depending on the sophistication of the buyers. And see, that's where I prefer real estate investing over stocks. Stocks, you're competing against very sophisticated computers and people. In real estate, when you're shopping for small deals like single family, duplexes, triplexes, fourplexes, you're usually competing against people that own 0 to maybe 1 other property. In fact, 90% of buyers don't own more than 2 properties in the smaller deal space. So you're really competing against people that are really unsophisticated. It's kind of like shooting fish in the barrel to get good deals. And yes, that's exactly what I teach in the real estate investing course, but I'm gonna give you an example right here. When I buy a property for $450,000 that needs $50,000 worth of work, so I'm into it for $500,000, the market value of that property is not $450,000 or $500,000 that day. The market value is the average of the sales in the neighborhood of a similar square footage. So when I look at a neighborhood and I see, okay, we have 4 properties that just sold. They're all 3-bedroom, 2-bath. They all have a 7,000 square foot lot. They're all single story, single family houses, and they're selling for between $590,000 to $625,000. The midpoint there is somewhere around $612,000, $615,000, $610,000. I know that somewhere in that range is the actual true market value of the place that I bought that I'm now into for $500,000. That is what I call buying in the wedge. You're buying a property below market value, and the reason you're able to do that is usually because people are fearful of doing basics like paint and carpet. Now I have a challenge for you. Let's say you put 5% down on that place that you bought for $450,000. And then let's say you borrowed the extra $50,000 to do the fix-up. That's a lot of debt, right? In fact, you've borrowed more than you've really paid for the property. In fact, your total debt would be about $477,000. But because the property, after you do your fix-up, is now worth $610,000, what just happened? You just fatly insulated yourself. In fact, $477,500 divided by, let's say, a value of $600,000 is kind of like you put down 20.5% on that deal. You basically just created $100,000 out of thin air. You started with 5% down, just $22,500, and you turned $22,500 into well over $100,000 in value. Now guess what? The market could fall 50%, and I don't care because I just turned $22,500 into over $100,000. Now if the market falls 50%, I still doubled my money. I still took $22,500 and turned it into over $50,000. That, to me, is how you can capitalize on inefficiencies in real estate. I suggest you try to do similar things with stocks as well, specifically taking advantage of volatility by buying on red days. That is how I like to generate value. That's why I suggest, number one, increase your income. Number two, invest, invest, invest. And if you can invest in places where you can buy things below market value, that is how you're gonna insulate yourself. You're not gonna insulate yourself having your money sitting in a Wealthfront savings account earning you 2.3%. Now, I enjoy Wealthfront. I'm a big fan of Wealthfront, and if you don't yet have Wealthfront, I highly encourage you to create an account at Wealthfront. Now, my third recommendation is make yourself liquid. And what I mean by that is not just the cliche, go pay off debt, although that helps as well, but open up credit lines. That is, if you own real estate or you've bought a house to live in, consider going to local credit unions and opening up a home equity line of credit. These let you take out a line of credit up to 89.9% sometimes. Keep looking until you find a credit union that does that. Bank of the West, in the western part of the United States, imagine that, does that. These are really good tools to have on a rainy day or in case the market is a little bit volatile. Another thing I like to do is I like to have credit cards, multiple credit cards open that are all fully paid off. Now, while I never recommend paying credit card interest, the more credit cards I have, the more I realize that one of the credit cards always seems to be offering some kind of very enticing introductory rate for a period of 18 months. And sometimes they're not even introductory. See, for example, the Citi Double Cash card keeps sending me these interest rate emails saying, hey, you know what, for the next 18 months, why don't you just go ahead and enjoy this really low interest rate, below oftentimes what people's mortgages are for an interest rate. I'm like, all right, well, if I needed to pull out some money really fast to do some fix-up, I guess I could do that and finance it over 12 to 18 months because I don't mind paying really low interest rates. So having that fluidity, having paid off debt, having credit lines, while at the same time having more income and increasing your investments, it's really a strong way to prepare yourself for a recession, worst case if it happens. And best case scenario, you enjoy the ride and the gains. See, another thing that this actually does for you is the more money you invest, the less money you spend on crap, and the less money you spend on crap and the more money you invest, statistically, the richer you're going to be in life. Now, if any of this makes you nervous, consider parking your money into some things that generally do well in a recession. These could be things like gold or a Vanguard bond market index fund, even a Fidelity bond market index fund, or even just consider leaving your money in that regular high yield savings account over at Wealthfront. I wouldn't necessarily put all of my money into something like this, especially remember the recession roulette table is tilted against the odds of these doing very well in the long term. And that's why, to me, buying below market real estate and buying stocks that I like or index funds that I like on red days are the things that I'm going to keep doing. In the meantime, I kind of laugh in the background at what I call the Trump recession. In fact, if you haven't watched my video on the Trump recession, consider checking that out. It's a pretty incredible theory that I actually strongly think will hold true, especially with news over the last week continues to sort of reiterate that, yeah, this is just the Trump recession, not a real recession. Thanks so much for watching. Follow me on Instagram, and until next time.